I don't necessarily want to just take my existing systems and scale them directly up. I want to evolve and grow those systems so that they'll be better than they are today, not just bigger. I want bigger and.
Welcome to Multifamily Insights. I'm your host, John Kasman, and I want to thank you for joining us for another great episode. Listen, if you're enjoying this show, getting good value, and it's helping you become a better multifamily investor, leave us a rating and review. Give us that feedback, but also let us know what we can do to make the show work harder for your investing goals. And if you haven't done so already, make sure you hit that subscribe button so you don't miss an episode. We've got a great show today. We're going to bring back a good friend, Mr. Taylor Loht. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to KasmanCapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to KasmanCapital.com and click on the Mastermind button today. Taylor Loht is an experienced multifamily and self-storage real estate investor who decided to break into real estate in 2015 following Wall Street's major correction that year. Now, the time since he made the shift, Taylor has acquired, invested, and partnered in over $150 million worth of real estate. Let's welcome to the show, Taylor Loht.
Hey, John, thanks for having me. I need to update my bio again, I guess, because it's over 250 now, but who's counting?
That's just $100 million you've got to include. Don't worry about it. Hey, Taylor, I went over your bio at a high level. Why don't you take 2 minutes and fill in some of those gaps?
Sure, absolutely. So as you mentioned, I got frustrated with Wall Street around 2015 when there was a oil price crash and, a lot of issues around that. And I saw that I'm not getting out of my investments anything right now. I'm just building up a pile that hopefully will be big enough by the time I want to retire. And around that time, I just so happened to read one of these books that's over my shoulder that you can't see behind my mic, but it's Rich Dad, Poor Dad. Every real estate investor has read it, and my story is much like theirs. He taught me about the power of cash flow and how real estate investors and business owners build cash flow. And I was instantly hooked, even though I didn't have any cash flow coming in at the time. So got into the space, learned about real estate investing, all the different strategies, and ultimately made my way into syndication, which is how I invest today.
I love it, man. So listen, if you want to learn more about Taylor's backstory, check out our previous episode 282, passive strategies for business, passive real estate investing strategies for busy professionals, where you go into a lot of the details and a lot more of, what Taylor was doing at that stage. Taylor, we're going to fast forward a little bit to kind of where you're at today, right? So you mentioned that you're up to around $250 million worth of real estate that you've been involved with. And being involved in real estate at this stage, particularly in commercial real estate, can get a little, tricky, right? There's a lot of layers. We talk a lot about this being a team sport. You got the LP side, you got the active side. Talk to us a little bit more about kind of deals you're doing today. I know you got some self-storage, some apartments. Give us a little bit of kind of what that portfolio looks like.
Sure, absolutely. So in the apartment space in particular, my investment strategy has evolved, I would say, quite a bit. I originally started with C-class apartments, and this was a few years before COVID had hit and before we had all of that price appreciation, everything that folks are going to be well aware of by now. Back when C-class properties were honestly kind of cheap, you could get them at an inexpensive basis, bring a bunch of capital to the table, and it's kind of made sense. You could have expenses pop up that are going to cost you a pretty penny and not add to your NOI, but you got the property so cheap and you could add value to the extent that you'll still make money on the deal and not have an outsized risk. Well, did some C-class apartment deals, and those skeletons in the closet in older C-class properties, honestly, I hate them. They're things that pop up that, again, cost a lot of money and don't add to your NOI, which is really the goal. You want to drive your net operating income so you can increase your value and sell a few years later. So after taking some of those hits, now we made money, but still having that big headache is not a lot of fun. And considering where we find ourselves in the market today with more uncertainty than we had in the past, I decided to shift my investment strategy to more B to B plus class assets. And more specifically, in that vein, I focus on the age of the properties when considering whether something is a particular class. C class properties tend to be much older and therefore much more likely to have those skeletons in the closet. And just to highlight a couple of big ones that had popped up for us in the past, plumbing and sewer issues. You can have pretty significant water main breaks and clogs that in one particular deal for us shut down one of our buildings for months and months. We had to find tenants other places to live. And this was before COVID. So, wasn't totally the end of the world, but still not a great problem to have pop up. AC units and roofs and things along those lines that end up being big expense line items. And for me, that was properties that were built in the 60s and 70s. So today, I prefer to invest in 1980s at the oldest, or preferably newer, 90s to early 2000s properties. Those are a little more difficult to find that are B class and, at an attractive valuation to invest in. But, to highlight it, the real main difference for me has been aiming to invest in slightly nicer, not top end, but, middle grade properties that frankly, I would be a little more comfortable living in personally. They're not totally dilapidated. They're not the nicest thing on the planet. So you're not spending, an arm and a leg on rent, but still you have a good working class population, families, all that kind of thing in solid neighborhoods. That's what I'm looking for.
Yeah, I love that your description there because it's very similar to our strategy, right? But you talked about starting off in kind of C class properties where these are more 50s, 60s construction properties. And now you focus on B plus type properties, which are built in the 80s, 90s, 2000s, and mainly because of those things in the closet that pop up, right? Some plumbing issues, sewer line issues, and these costs can get pretty expensive, especially if they keep happening on units, right? Those plumbing stacks. I know we got killed on a property with plumbing stacks. I mean, I felt like every week I was talking to the property manager about a new plumbing issue. And I'm like, did we just fix this? He was like, no, that was the one in unit 13. This is one in unit 17. I'm like, oh my Lord. And it just felt like it never stopped. Right. So that's definitely a thing you have to be very mindful of if you're going to invest in some of these older assets. So we talked about apartments. Talk to me about your investing strategy with self-storage.
Absolutely. So in the self-storage space, I like to invest in existing properties with expansion potential in markets that have unmet demand for self-storage. And that's very important. I actually had somebody schedule a call to speak with me about some land that they had bought for potential self-storage redevelopment earlier this week. And nice early morning call, first thing after going to the gym at 6 a.m., sit down, talk with somebody about a property. I love it. And they had vacant land, and the biggest kind of hole in the whole plan here was laying out exactly what the current supply is, how occupied it is, and what the unmet demand in that market is. Because in my experience and my observation in self-storage, that's kind of your biggest risk that you can mitigate just through analytics on the front end, understanding what's your competition and how many people in the market are looking for space, particularly if you're buying an existing facility and you intend to expand it. So we look for existing facilities with essentially just vacant land, either attached to them or right next to them, that we can get and expand and sell within a few years. Now, the tough thing is in today's market with these high interest rates, with lower loan to costs and loan to value and everything that banks are putting out there, and still at elevated construction costs because inflation happened and we certainly haven't experienced deflation in the construction space. It's a lot harder to find good self-storage deals with that value add opportunity today than it was. And a lot of the big self-storage developers are seeing that same thing. Now, my mentality and the thing that I try to remember at all times in investing in real estate, no matter what the condition it is that this too shall pass. So whatever it is, this won't last forever. One day, something will change and there will be deals out there to be found. But the tough part is with self-storage that you're going to expand. Today, it's really difficult to find a deal that works.
Yeah, I think that's really interesting because it sounds like a lot of the focus is on kind of that market demographic information, right? So it's how much demand is there in the market? Is there expandable land where we can add storage units and really trying to understand, hey, what is the demographic story here? Whereas with multifamily, it's more about the operations, right? It's more about, hey, what's the age of the asset? How much money do we have to focus on for repairs? Who's the tenant base? All that kind of stuff. With self storage, is really just, hey, there are enough people looking for self storage that we're gonna have clients, and we're gonna have people renting this space. So I think it's really interesting that you can focus more on kind of the demographic aspects, but then also finding that value add opportunity. And obviously, it's been a challenge with some of the economic changes, but still really interesting just to understand how you're looking at it. You've kind of expanded from, like we said, multifamily to self storage, but also building different partnerships. And I think one thing that's really interesting is that you're able to get into very different deals with some of the relationships and partnerships you have. Can you talk to us a little bit more about kind of how you've built the business and the structure?
So, with pretty much everything in my business, my podcast has been a huge part of building out my network and building my knowledge base. And probably thirdly, just building my knowledge of ways that I can grow and expand my business, building the things that I know that are going on in the market that are not necessarily public information. And you and I chatted a bit about that before we hit record here, and we'll leave that there. But that boils down to staying connected with others in the market and having close one-on-one conversations just to share knowledge, share information about what's going on. And it's not just the podcast, of course, setting up calls with people who I know who maybe I haven't spoken with in a year and just saying, hey, so-and-so, you want to jump on a call and see how things are going? Most people are open to that. So that kind of networking and sharing knowledge has been key to me to grow. But moving beyond that, another big aspect for me, not just of growing my podcast, but in general, making sure I could think about things at a higher level in the business has boiled down to hiring people to handle things for me. And that was recommended to me many times before I took action on it. But the key one that made a big difference for me was sitting down at a mastermind about, honestly, it was the weekend before COVID lockdown started in the US. So back in 2020, March 20, hey, you were there. Of course, you were there.
Yeah, we were at
right.
the mastermind together.
Yeah,
Yes.
no, I wasn't even thinking about that. That was great. And so it was specifically sitting down to dinner with Jay Scott and Matt Faircloth that were at the table sitting next to them and talking to them about their businesses and everything. And I believe it was Matt. It's been a few years now, but Matt talked about building teams and hiring people so that he could focus on tasks that were, I think, $500 or $1,000 per hour, somewhere in there that he was valuing his own time at. And if he could hire someone for cheaper than that, say a VA overseas, or heck, even someone in the US, then he was pretty much obligated to do so for the sake of his business so that he could focus on those higher dollar per hour activities. So I went home and analyzed, okay, what can I do? What do I need to do? Who do I need to hire? And started taking action to hire people in the business to, say, handle some of the back end on the podcast, just handle logistical things. And I didn't know right away what I would hand off. And honestly, I was a little uncomfortable with making the investment, right? People aren't free. And I was doing myself a disservice because I was valuing my own time at nothing, right? Because I thought people weren't free. But in reality, it was much more expensive to dedicate my own time to those things. So started hiring people on the back end to handle things like podcast editing, talking to guests, and everything along that, so that I could focus on talking with my investors, building better systems to automate the back end, building out my website and funnels and things along those lines, networking with others, because just a few weeks after that, everybody was stuck at home. So it was a great opportunity, even though it looked like the world might be falling apart. It was a great opportunity to build connections with others outside of the area. So I'm at a phase in my business where actually just Joe Fairless, another connection of ours, spoke with him about a week ago. and he's pushing me to grow my show from 3 episodes a week to every weekday. And who in the world am I to try to push back on that? This guy who's done an episode a day for, I don't know, 8 or 9 years, something like that. How can I say I can't do an episode every weekday? So right now, I'm in the phase of, okay, how can I build a system to execute that effectively? How can I get enough guests to fill those slots? Great guests, especially. I don't want just anybody. And who do I need in seats to handle those things? I don't necessarily want to just take my existing systems and scale them directly up. I want to evolve and grow those systems so that they'll be better than they are today, not just bigger. I want bigger and better. So that's what I'm working on, right now. And I'm so excited about it. I'm a little intimidated, but I'm committed to making the change and, seeing it through.
I love everything you just said, man. First of all, going back to that mastermind, you're spot on. I remember we were there and it was the week before COVID really hit. Obviously, well, let's be clear. It was the week before the shutdown hit. And we had a lot of great conversations in that mastermind. But you took that to focus on how do I start to outsource some of this workload and actually grow. And I think that's a huge step. And I appreciate you being transparent and sharing that, because so many people who are looking to scale have a hard time making that investment and that commitment to paying someone else, because the fear is, well, what if I'm not generating enough capital to pay this person continually, right? Maybe you have 3 months or 6 months of money that you could pay somebody, but you need to see that return, right? You need to see that ROI. Like, you can't pay somebody for work you've been doing for free, right? You haven't had that responsibility, but now you're going to pay somebody else. Whew, that's pressure, right? That's pressure that we gotta get going. So how are you able to get comfortable with that? It's one thing to say, okay, hey, this is $1,000 task, but you weren't writing yourself $1,000 check. So it's not like you were losing this $1,000 and you were doing it yourself. When you're paying someone else, that money's gone. How were you able to reconcile that so that you could get comfortable making that investment?
Well, the truth is that it's not comfortable. Honestly, it's not comfortable. But when you understand and can see the reward on the back end, even if you don't have your eyes on the specific reward, but you've done deals before, you know how deals work, you know that if I put the work in, then it will pay back. You have that confidence and faith, then, I think you have no choice but to take the risk, in a certain sense. I mean, we can always look for ways to reduce that cost. If it's a commitment to okay, I'm going to hire someone. Well, okay, maybe I commit for 3 months internally. And if I'm not seeing the type of traction that I need, then maybe I need to go back and reconsider. But it's not just setting a finite timeline about 90 days or something like that. It's looking at people who have achieved what you want to achieve and understanding what they did to get there. Guys like Joe Fairless, man, he was hiring people right off the bat, hiring a ton of people. Another great guy who we're both friends with, Whitney Sewell, man, he has made a lot of hires over the years. And I've had many conversations with him about how he built his team out initially, particularly when it was just money out of his pocket before the business was generating revenue. He really committed. And another coach of mine who provided a lot of great insight, one thing in particular, Trevor McGregor, gave me this, I guess you could call it an audiobook. It's about a half an hour long, which you can just go look up on YouTube if you want to find it. Earl Nightingale, The Strangest Secret. It's reframing what success means and how money is generated, how we get money. We don't make money and then become successful. We have to be successful first, and then we make money. And when we look at it in terms of, okay, once I make money, then I will do the things to become successful. Well, you never end up making that money. And I believe the analogy that Earl uses in that is it's like going to your stove and telling it, first make fire and then I'll add the wood. Well, it doesn't work that way. You need to add the wood to grow the fire. And having that understanding and always framing things in that way has helped me to continue making that investment. And then, especially once you've done deals and you see that, okay, these things do work and they do, make money as long as you do everything right, then, it's a lot easier to stomach that initial investment because you understand that there is a kind of hate to say this, but there is a pot of gold at the end of the rainbow, if you will. It's
There
kind of
you
gross, but you know what I mean.
go. Well, Taylor, I think it's helpful for people to understand um, the tension that you felt in making that investment, right? Because it's tough when you don't have an endless amount of capital and you're looking at it and you're saying, hey, I've got 3 months that I can commit to before I need to see a return on some of this money, right? But the point you made was, one, you have to have the vision, you have to believe in it, but there also needs to be a commitment. And part of what you're doing when you make that investment is you're committing to that path. But it's not just, hey, let's throw this money out and pray it works. It's, hey, this is going to free me up to do the other tasks that are more important to grow the business. So maybe that's spending more time with potential investors or finding deals or talking to brokers or whatever it is. When you're making that investment, figure out what you can offload off your plate so that you can focus on those tasks that are going to help generate the most revenue. Because that's probably what's holding you back is you're not doing and you're not spending enough time doing the things that you need to be doing to grow the business. So think about it from that perspective. How do I focus on what I'm uniquely gifted at or what the business needs the most so that we can grow as opposed to maybe some tasks that are more administrative? So great insight right there just on how to think about it, talking about your mentors, talking about some of the books. I wrote down that Earl Nightingale book, The Strangest Secrets. So it's definitely one that we'll check out as well, but great insights there. As you've grown your business, I know that you made the decision to become a licensed broker dealer. And that's something that I know I talk to a lot of people in the space and they're interested, they weigh it, they're considering it. What was your process like in deciding that that was the path you wanted to take?
Sure. So at the time when I made that move, I had been a general partner on a few apartment deals and, done the whole spiel of asset management, all that thing, and helped raise capital and all the things that you do as a general partner in syndication deals. And I saw a few things. I saw that my favorite part of the business, the part that gave me the most energy, was working with investors. It was locating people who I could help. It was honestly getting them to invest in the deal and getting their buy-in, having them invest and take the ride along with us. It's just very incredibly rewarding. It's something that I can do and it just doesn't feel like work. I mean, granted, there certainly are times where, you have to put your nose to the grindstone and force yourself to do something, even if you enjoy it. But I didn't get the same juice out of schmoozing with brokers. I do like going and looking at properties, but it's just not, it doesn't compel me in the same way that working with investors did. And so I knew that much. I knew that that's the thing I wanted to do. And there are basically three ways that you can do that. And they're not all equally legal, but there are a lot of folks doing the, just raise capital and, call myself a GP and we'll leave it at that. Well, not really legal. So I wasn't going to build my business that way. That was a 100% out because I love being able to sleep at night and not have to look over my shoulder. It's just the way I live my life. Second one, start a fund of funds. Well, when I was kind of going down this path, there weren't as many resources for starting a fund of funds as there are today. They've really grown up, especially through COVID. I think a lot of tech entrepreneurs sat down and created products, but still there's something about that adding an additional layer of fees and, just all the things involved with that, I still don't think it would particularly appeal to me. Or there was a route of, becoming licensed with a broker dealer and raising capital that way. There certainly are downsides with that, if you will, because not only are we regulated by the SEC, we also have FINRA, looking at what we do and what we can say with investors and things like that. Certainly a big consideration. And it was probably maybe a 5 to 6 month process for me of getting books and studying for the test. Now, honestly, to me, that part was, I don't want to say easy, but straightforward. I have a degree in chemical engineering. I can study and take tests, no big deal. And worked hard so I would pass them all the first time. So not a big deal if you're willing to invest the time and learn the things that you need to know. But really making that decision and making the investment in myself, not only of money to actually get the materials and study and everything like that, but of the time to sit down and take all the steps required. Well, it unlocked a lot of doors for me. It unlocked a lot of deal flow and opportunities that I could present to my investors, because in that period where I decided I wanted to focus on raising capital, why it took probably about maybe a year and a half without doing a deal, something like that. And I look back on that time. Of course, it would have been better to do a deal. I can't lie about that. But, a year and a half, not that long of a time. And it really set me up to get in a position where today, we've had pretty significant amount of deal flow, at least, compared to back then. Things have slowed down in general in this space because of higher rates and, what have you. But, making the commitment and investing in myself has paid off, and very glad that I did.
Taylor, some folks may not understand the term broker dealer. Explain exactly what that is and what the benefit is compared to some of the other routes you mentioned.
Sure. So the broker dealer essentially brokers securities. So when you invest in I know I just used a word to define a word, but when you invest in a real estate syndication, you're buying a security essentially. And that's why there are all of these unlicensed broker dealers out there. That's why they're not doing it legally, because you cannot legally sell a security without being a licensed broker dealer, unless you're part of the issuer. And there are a lot of people doing this co-GP thing, saying they're part of the issuer, but really they're just being compensated for selling a security. But broker dealer essentially works with the issuers of the securities, which are the syndicators, and then the investors, and pairs them up so that, the investors can invest in the deals and it's all hunky dory. It's pretty much very similar to the syndication space. I mean, our investors still invest in effectively the exact same deals, although we do a lot more screening of the sponsors, the deals, and everything like that, a lot of background checking of the individuals and, what have you. But our investors essentially still go into the same deals. There are just things that, again, we can't say to investors that a syndicator can say. One good example is FINRA does not allow us to talk about IRR. Just, it's right in the rules. Forward-looking projections, so on and so forth. You can go look that up. But IRR is a very common metric in the real estate syndication space. Now, even prior to getting my licenses, I'm not a fan of IRR. It's a metric that you can really game. And I see a lot of syndicators doing that because of the time-bound nature of it and so on. But, beyond all of those additional restrictions and rules that we have to abide by, I think it's a good deal for the investors because they get into the same deals. We do a lot of that vetting for them. And it's a good deal for the syndicators because they get a way to scale their capital raise without, say, hiring someone that's just a cost to their team. We just help them grow the deals and kind of move on and stick with the deal and hang on. But we're not somebody in their office that's a fixed cost and just adding to their payroll, essentially.
Yeah, Taylor, appreciate you sharing more about that approach. If anybody wants to learn more about that or working with you and your company, they can go to your website, ntcapitalgroup.com, or you can go check them out at investwithtaylor.com. Right now, we're going to move on to our round of insights. You ready?
Yes.
Give me a failure or an apparent failure that set you up for later success.
So one of my early deals in the BD space was the first one, I believe, that I had gone out to my investors. Failure was none of my investors invested in it, right? I didn't bring any capital to the table. And, the deal was okay, right? I thought it was a good deal and it worked out and everything. But the reality is that I hadn't presented a deal to my investors, as I said before, for about a year and a half. So even people who had previously invested with me in deals and made money and everything, they hadn't seen me do a deal, so they were not interested in getting involved. So really the important thing there was seeing the importance of consistency. Now, I was in front of those investors on a weekly basis with my weekly email newsletter, but still where the rubber meets the road, people want to see you doing deals. Now, that was a little while ago. Of course, things have certainly turned around, but when you come up short on a deal, no matter how you're doing it, it doesn't feel good. And there are very important lessons out of that. So, the importance of consistency.
Give me a digital or mobile resource you recommend for your business.
ActiveCampaign has been massive in my business because it integrates well with websites and services like Calendly. But beyond that, its ability to automate things within your business is incredible. It's very flexible. You can build a ton of automations, and that has helped me build things like reminders. When somebody signs up to speak with me about a deal, but maybe they sign up for the email list but don't schedule a call, well, I have automations that will automatically, drip them reminders, get them to schedule a call, and what have you. And there are other more detailed things that we do on the back end with tagging people, sending out deal updates, things like that. But going back to investing in your business, well, ActiveCampaign, even the kind of modest package, I think is like $1,200 a year, something like that. And it certainly goes way up from there. It's not the cheapest, but it's also not the most expensive CRM, but its ability to automate, again, it's worth the investment because you take a lot of that mental load and a lot of those activities off of your plate when you build automations to handle those things for you.
Give me the book you've recommended or gifted the most in the last year.
So it's actually one that our mutual friend Joe Fairless recommended to me many years ago now. It's one right here, Crucial Conversations. I'd originally read that book and recommended by Joe. I think at the time I was in my mid to late 20s. I'm in my mid 30s now. It's been a little while, but building skills to have difficult conversations with people, whether it's business partners or investors or heck, your spouse. I wasn't married at the time when I read that book. I didn't even know my now wife, but the skills that you can build by learning how to have difficult conversations with people and make sure that you can maintain a relationship while talking about a difficult subject, whatever it is so important. Like I said, I have a technical background. I didn't appreciate in my earlier days the importance of your ability to deal with others. Now, first book I read in that vein was How to Win Friends and Influence People, and that started putting me down the path. Certainly a great book, but Crucial Conversations, very important.
Give me a daily habit that helps you stay focused on your goals.
So I train Brazilian Jiu-Jitsu. Probably now, I can't literally say it's daily, but I do about 5-6 days a week, get up, go to 6 a.m. class. And that helps me take action early in the day, step out of bed. That's the toughest part, is getting out of bed when the alarm goes off at 5. But if you make that one step, that sets you up for, as they say, eating the frog, especially early in the morning. Do those tough things. Now, another one that I do actually do daily. I can't train jiu-jitsu every day. I get too beaten up, but I did 75 hard last year. I tried it a few times and failed, but last year I was just, I'm doing it. I'm not failing. No way. So I made it all the way through and working out twice a day, following a diet, all these other things. The big one that I've kept out of that was cold showers. I hate cold showers. I like warm showers, but now I take cold showers because it's another one of those things of eating the frog. I'm vegetarian. I don't eat frogs, but doing a thing that you don't want to do. Turn it on cold, get in the shower, taking those actions. I think working that muscle just sets you up to take difficult steps in your business. If it's something that you're putting off doing, something I might do this week or next week, but I know I could just take care of today. If you do those things in your daily life, I think you're more apt to take those difficult actions in business as well.
I love it, man. Give me your number one insight for raising capital for real estate deals. Let me say that a little differently. Give me your number one insight for raising capital for real estate.
help people. People have questions. Investors have questions. Some of my investors ask an awful lot of questions about our deals, and that's okay. We answer their questions to the best of our ability and how we need to do for compliance purposes. But people ask questions because these are, again, illiquid investments. People know that. They can be difficult to understand some of the legalese, or difficult to understand the business plan, things along those lines. You're going to get potentially a lot of questions when you're doing real estate deals. So help people understand, even if the answer to their question is what you might consider a downside of the deal, even if the honest truth is a weakness, tell them about that, because they will appreciate, at the end of the day, your integrity. And that's what builds long-term investor relationships. I'm in this business for good. I have no plans to get out of this business. My honest hope is that my investors today will continue to invest with me for the rest of their investment careers, as long as these, investments are suitable for their goals and things along those lines. And I think that starts with having that integrity to be transparent, answer difficult questions, even when those questions might be a weakness.
I love it. All right, let's lighten the mood, man. You are out there. You're still like not DC, but you're kind of that
Richmond.
Maryland, Virginia, Richmond area. Yeah. So you're out in Richmond. Give me your favorite place to grab a bite to eat.
My wife and I like to go to this small pho restaurant. It's called Fote Do. They only take cash. They don't take cards. It's in a little, probably 800 square foot house. They have the best pho in the city. My wife and I went there pretty much every week when we were dating. And now we go a little less often, but we still go pretty consistently. Best place in the city, but bring cash because they don't take cards.
All right. Listen, it may just be me, but what is pho?
It's a Vietnamese noodle soup.
Okay. Maybe I've been reading that wrong for all these years. Well, listen, Taylor, it's always a pleasure talking to you, man. It's great catching up. I know we had a chance to talk a little bit before we hit the record button, but I appreciate you coming on the show today and, just talking about your journey, going from corporate America to, focusing on real estate. And then that inflection point where you really had to focus on investing in the business, even when you felt that it was not necessarily premature, but you weren't 100% confident or ready to do it. You recognize that this is what you need to do even before the money was there. And I think that's a really great insight for all of our listeners to take away. Do the thing that's hard. Do the thing that will result in the outcomes that you're looking for, even if you're not 100% ready for it right now. That's the steps you got to take to move in the right direction. So I thought that was really powerful. And then giving us a little bit of information on kind of being a broker dealer, why you decided to go down that path, and more information on investing in general. Again, if anybody wants to learn more about what you're working on, they can go to your website, ntcapitalgroup.com, and they can also go to investwithtaylor.com to learn more about your podcast. Taylor, thank you again for being a great guest coming on Multifamily Insights. We look forward to staying in touch with you and hope you have a great day.
Thank you.